10 years ago, Wall Street and Main Street were devastated by the 2008 financial crisis. Now, while many struggled, a few investors saw the crisis coming and were able to successfully navigate it. Ray Dalio, the founder of Bridgewater Associates, the world's largest and most successful hedge fund, was one of them. Now, inevitably, there will be another crisis, and Ray Dalio is now sharing the same principles that helped him back in 2008 in a new, and get this, a free book called A Template for Understanding Big Debt Crises. Ray joins us now. Ray, welcome. Thank you so much for being here.
Thank you for having me.
All right, so Ray, our audience will obviously want to know, how were you able to foresee the last financial crisis? What signs were you seeing that everyone else was missing?
Well, the way I look at it is it's like a disease. It's like a process that happens over and over again. And so I laid them out in 6 steps and then described them in 60 pages, really, the sequence of how to look at each of those phases. So that basically, you know, there's I don't know if you want to get into the 6 phases.
Oh, we'll get into it in just a bit.
Okay. But there's a process. Everything that happens has a cause. And by understanding that process and cause, you know the red flags. And with those red flags, you know how to calculate whether people can pay their debts back and how the dynamic's going to work. And that's why I want to pass it along, because in those 60 pages, people then can learn that. And I'm at a phase in my life where I want to pass along those things that could help other people and ideally help to prevent the next debt crisis, or at least help people navigate it.
Okay, so we're going to get into those 6 stages in just a bit, but I do want to go back to that time around just before the crisis when you were at Bridgewater, and you have this process in place. But what was it? What was that red flag for you? What was really flashing for you at that moment where you realized this was coming?
Well, we had calculated that a number of the entities would not be able to pay back their debt. When there's a certain rate of debt growth that is unsustainable and that there's going to be a problem paying it back, when you do the calculations, you could see that you have a problem. When you start to have a debt problem and you're close to 0 interest rates, that means that the central bank, the Federal Reserve's ability to deal with that won't work. You'll hit 0. And then you enter a new world. Okay, the last time that happened was 1928 to 1929, 30, 31. That's what happened. What happened in 2007 and 9 was the exact same thing. A debt crisis, too much debt, and you hit 0 interest rates and out of luck. And then what happens, there's a classic way of dealing with that, is that the central bank has got to print money and go buy financial assets. And so that's what all the entities did. And so by being able to watch it day by day as to how they went about doing that, allowed us to navigate the crisis so that we could see the rates of deterioration and then the actions taken to end that in much the same way as the Federal Reserve ended it in 1932, 1933, for the same reasons. Now that printing of money and the buying of financial assets causes financial assets to go up in price, right, puts money into the economy, and produces the type of reaction that we've now seen in terms of that economy and those markets. Then we're at the stage of the cycle where we are now. And what happens, classically, is that those financial purchases help those who have financial assets more than they help those who don't. And it causes a greater wealth gap. And very classically, that causes populism.
Right.
Because there's a gap between the wealth, on the wealth, and then you move into a situation that's very similar. So being able to see mechanically how that dynamic worked allowed us to navigate it well.
And history does repeat itself. These are patterns that repeat over and over. Now, you did highlight in your book 6 stages of the debt cycle. But if you could zone in on those 6 stages, which stage are we in right now? We have a graphic up right now.
Yeah, so I'll touch on it. The early part of the debt cycle is the great part of the debt cycle because the borrowing of money is being put into assets that are going to be able to pay back that debt and grow, and asset prices go up. Then you enter the bubble stage when everybody is extrapolating that because it happened in the past. Because those assets went up, they're going to continue to go up. And they're going to continue to rise, and it pays to borrow money to do it, but they're not able to actually pay off their cash flow. The top of the cycle usually happens when when the bubble exists and also the Federal Reserve or the central bank begins to tighten money to slow that bubble at the high part of the cycle. So as we take a look at that, we are approaching more the top of that cycle. I don't think we're there yet. I think we're in the 7th inning. When you have that tightening and then you have the turn down, and what I'll call the depression phase, that depression phase happens because you hit 0 interest rates and because they're less effective in monetary policy. That's why 2008 was like it was in much the way 1930 was. And so that's the depression phase. You can then, the central bank has tools. And so, in my opinion, on this long-term debt cycle, we are relatively late in a longer-term debt cycle. We're relatively late in a business cycle. That doesn't mean imminent. I mean, I think there's 2 or 3 more years probably in this. I'm not sure for sure. But we are then going to have a downturn at some point. Downturns always come, recessions always come. And what we have is a situation in which the capacities of the central banks to reverse it are more limited because interest rates are close to 0 or is at 0 in Europe and Japan. And also the effectiveness of monetary policy is largely, quantitative easing is largely behind us because they have put that money in and those asset prices have risen. We also have another issue, which is the wealth gap and the populist issue, because, which is, I think, worse than it was back then. So imagine today, we have the best economy that you probably we're going to get. The unemployment rate is low, the stock market is where it is, asset prices are good. These are times that are good, but we have this polarity. So if I'm looking at 2 or 3 years forward, that's the period that produces greater concern. So I think we're relatively late along in that cycle.